We're going to talk about the US debt, and I think very few people are having an honest conversation about the sheer size of this and the rate at which it's increasing. I think there's a lot of effort to intentionally make these numbers hard to understand and hard to find. And there's experts, giving projections that get revised, much later, and then they pretend like they knew all along. And so we're going to take a look, and I want you guys by the end of this video to actually have a good grasp at, where we've been and where we're going. So these numbers, these values here are shown in billions of dollars, right? So in 1929, the U.S. debt was just $17 billion. Obviously a lot for that time, given, what $17 billion was worth. These numbers here show, exactly how much year over year that debt was increasing, right? So you have these massive jumps, right? 1932, debt increased 17%, 17% a couple of years later, 17% a couple of years later, right? And, there's these big pockets where, again, you have these massive jump ups, whether it's because of the war or, big social spending programs, whatever went on, right? Now, having a summary on this, I think, is important. And so the debt in that time, since 1929, right, has increased 5% or more year over year, 67 times, right? Then the debt has also increased 10% or more, 26 times. That's a gigantic number, right? And these are, mind you, these numbers compound, right? So if it increased, from one year to the next 10%, and then 5% again, right? That's 5% increase on the 10% increase, right? So I think it's important to understand that. And for just a massive number, right? I mean, the debt has increased by 15%, more than 10 times in that same time period. Pretty scary. Now, I think another way to look at this that's really important, from the start of America to 1985, in that entire time frame, we accrued as a country $1.82 trillion in debt that entire time, right? Over 100 years. Just in 2023, we are now projected to have the debt increase this year, $2 trillion, right? In a single year. So you have 100 years versus 2, right? And so I think the way to think about this and why this is important is there's so many people that think they're an expert, that give predictions and whatever based on a model, but the reality is every time people are giving a projection based on a model, in most cases, they're looking at the way the chips are laid out right now, right? And they're not really able to effectively factor in where things are going and the exponential increases of, interest payments on the debt and extra, parts of the deficit getting tacked on to be more debt, right? And so, again, people give these projections, but I think they lack the vision to see just, again, the measuring stick you're measuring asset prices against is an expanding unit in the dollar. And I think that's really important to note. All right, so now let's look at Treasury.gov. Of course, this data is a couple days behind, but I think this is really important to look at. Okay, so this is 9/22. Today is September 25th. So as of 3 days ago, the debt was $33.1 trillion, right? Now, keep in mind, on the 14th and 15th, we just crossed over $33 trillion, right? This is a massive milestone to cross over. And in just 7 days, we added another $100 billion of debt, right? Right now, as we make this video, as we're talking here, the market cap of Bitcoin is $500 billion, okay? So in 7 days, the entirety of the U.S. debt increased 20% of Bitcoin's entire market cap in just a week, right? This is an astounding rate that I think very few people are considering, right? So again, crossed 33 billion here on the 15th. Now, let's see where the prior 100 billion rate happened on the 6th. So from the 6th to the 15th. So 9 days, the 9 days prior, that was another $100 billion, right? So 9 days and 7 days, 16 days, we added $200 billion of debt to the total U.S. debt in just 16 days. You can extrapolate those numbers out over the year, and at that rate, I mean, man, you're increasing the size of the debt by much more than $2 trillion, right? And you'll notice if you look through this chart, there's certain days where whatever, it'll maybe it jumps backwards if $10 billion or so, but then you just get massive jumps up, 50 billion, 20 billion. And again, these numbers compound on each other because all this new debt is getting financed at these much higher numbers, right? So Eric Voorhees had a tweet that I saw today that I think is important to notice. Okay, so a lot of people keep their eye on the Treasury 10-year yield. So right now, earlier today, it sat at $4.54. Keep in mind, every 10 basis points that this jumps up, so every 0.1% that this number rises, that means an additional $30 billion per year of additional interest expenses for the federal government, right? So keep in mind, whatever we bring in as a country right now in taxes is a percentage of what we are obligated to spend. So that extra gap between the two, that just gets tacked on as extra debt, right? And that extra debt has to have interest paid on it, right? Or else, why are people buying the debt, right? And so I think it's important to note who's actually buying these bonds, right? I think very few people talk about that. Now, there could be some subgroups, but I think the majority of the buying is really, 3 or 4 different culprits, okay? So the first one is, there's some people buying these bonds because they're like, man, I have no idea if the market's going up, the market's going down. I know inflation's higher than 4 or 5%, but I'll take a loss to at least get some yield to kind of sit here and run in place while I'm waiting to decide which way the markets are going to go. So you got individuals buying bonds for that reason. Now, a massive buyer of these bonds is banks with our deposits, right? So if you take money, you go put it in a bank. One of the things that the bank will do with your money is they'll take your money and they'll buy these bonds and they'll earn that interest on your money and share with you basically nothing, right? Which sucks and which is very unappealing. Now, there's been this whole thing forever that this is like risk-free. Of course it's not, right? And so the logic is a lot of these banks will buy these treasuries because if they buy enough, you almost become kind of in the club. And then if you ever were to need a big bailout or a big line of credit to kind of, make the books make sense so that you don't have to go under, hey, maybe the Fed will open up a swap line for you. Maybe the Fed will open up a line for you so you can access, money temporarily so that you don't have to eat the losses today. And this is what we're seeing right now, right? Where all these banks, piled in to these bonds when they're paying like 1%. And then whenever they jack those rates up, the reason why they're upside down on this is because if you bought let's say a multi-year bond paying 1%, and then the rates today are, 3 or 4%, and you want to go sell that into the market, who are you selling it to? You're selling it to people who could go buy something paying 3 or 4%. So they're going to say, hey, if you want to sell me that, I'm going to need a discount to make it make sense. And what does that actually mean? It means that you are not going to get the same money in, or you're not going to get the same money back that you put in to actually buy that, right? And so that's why banks are upside down on actually not having everybody's money. And the ironic part is one of the biggest sellers of these bonds to these banks was the Fed itself. And so what does the Fed do? Hey, don't worry. We're going to open up this new package here so that we don't take a loss on our books, technically. You don't take one on yours. You're not really upside down. You can meet withdrawal demands until people relax. And it's just a big confidence game, right? And this is kind of the scary part about the whole thing. Now, I think this is also a pretty interesting chart to look at. First, this caption. So as I mentioned, $1 trillion was added. I didn't mention this, but $1 trillion has been added to the U.S. national debt in just 3 months, right? So looking at this chart, this number here is the number of days between each trillion, each additional $1 trillion that was added to the debt. So when we crossed the 32 trillion marker, it only took 92 days to reach 33 trillion, right? And the scary part is you start to see these numbers getting smaller and smaller and smaller as we go. Now, to go from 1 trillion to 2 trillion, that took almost 5 years, right? To go from 2 to 3, it took 4 years, right? To go from 3 to 4, it took less than 3, right? And you see these spikes up here again, right? Where, it takes, let's say more than a few years and the trend kind of goes back the other way. But the point is all this is compounding on each other. And the challenging part is there's really not a fantastic way. There's no way to actually fully get out of this situation in my view. I think that the challenging part about it is right now, everybody's like, oh my God, we've got to fight inflation. How do we fight inflation? We got to keep rates high. And the real sinister part about that is by keeping rates high, you're effectively killing demand. You're making it harder for buyers to buy, right? And so if you're making it harder for buyers to buy, the logic is that sellers will be willing to come down on price to be able to make it appealing for buyers, aka prices come down, aka inflation's down. But the reality is you're just sort of moving the chips to one side until it's got to swing back the other way, right? Meanwhile, the net debt that we have is just increasing. And the longer that you keep rates high, all of this debt that was financed at like 1% starts to roll over at a much higher percentage. Thus, the interest payments increase, right? So this number here, as of August, it cost $808 billion to maintain the national debt per year. The military budget for 2023 is not even $800 billion. So now, as a country, we're paying more of our money that essentially we have to operate just to pay interest to people on our money that we've essentially already created, via issuing bonds, than we're spending on the military, right? And you think about how much the U.S. spends on the military relative to the rest of the world, it's insane, right? It's not a secret. So, all of this is to say, I think the conclusion is this. It's important to understand these numbers. It's important to understand how it works. Look, there's no way around it. They're going to have to print. When they print, and they actually issue these bonds and the money makes its way into the economy, the debt gets monetized. And when that happens, that money flows into the economy. And if the money flows into the economy, it's probably going to flow into the hands of smart people, big businesses, and people who are closer to the money printer, right? And what are they going to do with excess capital? They're going to buy great assets, right? Which is why you see great real estate, things like art actually follow in proportion with the money supply increasing, right? Because you can only make so much of these things. What are they doing now? What are some smart people doing now? They're buying Bitcoin with it, right? And if you see the way the biggest players are starting to position with the spot ETF, which we'll talk about in another video, they're getting ready, right? Because a lot of these people realize that Bitcoin is an asset that is completely different than everything else that's out there. And it presents a way to protect yourself from this behavior, because this simply is not going to stop. What's going to happen? Are they going to start to concede and say, okay, let's cut Social Security? That's unpopular. Are you going to cut the military budget? No, right? And if there are any cuts to these things, they're going to be so minuscule that it won't really have an impact, right? We're spending so much more than we bring in. It's basic math, right? If you're eating 7,000 calories a day and you only burn 3,000, right? You're going to gain weight every day. That's just how it goes. The numbers are that way. And so, in my opinion, again, I think that money, a lot of this same money that's been chasing bonds to get yield, is going to start to chase Bitcoin as an alternative way for people to be able to protect themselves against the behavior of the Fed, of the printing of the U.S. government, and of the printing of all these other countries globally around the world. So I hope you guys like this video. If this video was interesting, please subscribe if you're not, like the video, and I'm going to be releasing a lot more content here on the channel. You guys can comment if you have a certain topic that you want me to cover. Other than that, thank you guys for coming by. See ya.